Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional at the Cap and Capitalize. And on today's episode, we've got something very spicy for you all. The 5 financial pet peeves of mine. Okay. I actually have a lot of them. And so when I was thinking about this, the top 5, by the end of me actually creating the top 5 pet peeves I have, I was borderline heated. So I've cooled off a little bit, but my engine is still revved. However, before we get into those 5 financial pet peeves that, could unhinge me by the end of this episode, we got to give you the free advice for the day and the free tip of the week, which is, if you truly desire success, give up work-life balance. Now, I know that's going to sting some of you out there, and you're going to have to get over it and get used to it. There will come a time where you can afford to have more of a work-life balance, okay? I'm not saying completely eliminate it, but that's going to be a long time for most of you. And part 2 of that free advice that I want to give you today, this is a 2-parter, is now that you know it's going to take a while to become, to have the affordability to have some type of balance in life, whatever that means, you really need to fall in love with the process of getting there. And I'll tell you, if you live with the lackluster process that you will have lackluster proceeds. If you have wonderful processes and you love every single part of it, you will have wonderful and lovable proceeds. So you just have to figure out what you want in life. So give up the work-life balance, because that is a joke. It is sold inappropriately to you from an emotional basis. And then secondarily, fall in love with the process. And frankly, what's great about that is the more you work, the more you're actually going to love what you're doing. Obviously, you don't want to put everyone aside, okay, and cast everyone away, but love what you do, because you're going to have to do it for a very, very long time. And if not, choose to do something else, but fall in love with that process. Now, enough of that little rant of the free advice tip of the week. I'm going to read my top 5 financial planning pet peeves or financial pet peeves. Okay. Some of them are planning. And this is by no means in any particular order. And once I go through these top 5, then we're going to get into them in more detail. So the first one we're going to go over is risk tolerance questionnaires in general. The second one is lack of critical thought when it comes to finances. The third one is how advisors or certified financial planners, I'm using those in quotes, claim to be doing what is in the client's best interest, but in reality, most don't have a clue how to actually plan. Number 4 is going to be the obsession with getting rich quick, especially with Millennials and Gen Z. I am a millennial. And the 5th and final one we will go over before we wrap up the episode is the financial influencers that prey on the emotional unintelligence of their fans to cultishly lure them into their tribe. We got a lot to cover on today's episode. So let's get into the first one, risk tolerance questionnaires in general. So first off, what in the world is a risk tolerance questionnaire? So if you've ever worked with an advisor or a planner, one of the first questions that are going to be asked is, how do you feel about risk when it comes to investing generally? And there's a scale, and there's different terms, but basically there's conservative, there's aggressive, and then there's everything in between. So like conservative, moderate, moderately aggressive, something like that. And based on your answer, your advisor or planner is going to provide you with some portfolio that matches that emotion, okay? Which again, you're probably already putting two and two together. We're going to talk about this even more later in the episode. And once your emotion is matched with a portfolio based on the risk tolerance, that is now deemed appropriate from you from a planning standpoint. That is one of the stupidest things I've ever heard in this industry. And I can prove it to you with an actual research study. So, and not only is it stupid, it's actually statistically one of the worst things that you can start off with when it comes to advising and planning. And the reason why I say that is a study I actually read years ago. I think I've mentioned it a couple times on the show. I've definitely talked about it in my book. There is a he's not really a financial plan. He's a financial researcher in our industry, Rob Arnott. And I believe this research was in 2013 or 14, if my memory is not failing me here. And basically what he did is he took the idea of something known as a target date fund. And for those of you that have a retirement plan, generally speaking, the majority of retirement plans out there have a target date fund. So you pick the date approximately of when you're going to retire. And in theory, what happens is if you're younger, you have more stocks, which are considered more aggressive and riskier. And then over time, what happens is you have less stocks and more bonds, which are considered less risky. And by the time you retire, you have the stable portfolio and you're ready to rock in retirement. Like that's the theory. Okay. So what Rob did is he said, something's not right here. Or maybe something is right. I'm going to do something creative. I'm going to do two other studies. I'm going to take a time period, and he took we're talking 100 years. Okay, some huge target date fund idea. So he took 100 years and he made some giant target date fund. Then he took 100 years and he just said, hey, we're going to go 50-50 stocks and bonds. Okay, we're just going to keep it balanced the entire time. And then the last thing that he did is he took the idea of a target date fund and he actually flipped it on its head. So as you go through life, you actually get more aggressive with your investments. And you know what happened? If you did the opposite of what traditional target date fund planning is telling you, you would have approximately 22% more in retirement, which means your income would be increased by 22%. Like it's all relative. Who wouldn't want a 22% pay raise? I would. I know my brother would. We all would. Okay. So why does this tie into the risk tolerance questionnaire side of things? If someone comes in, especially if they're, like my brother in my age, okay, in their 30s, and they go, yeah, I'm really conservative with investing. Well, according to our, legal bodies in our industry, you can really only provide like a money market mutual fund or a bond fund or cash or whatever the case may be, very quote unquote conservative investments. Well, here's the thing with bonds over the last, I think it's 50 years, they've earned about 6%, but there's an asterisk there because with bonds, what happens over time is when interest rates rise, bond prices decrease and vice versa. They're inversely related. Well, as we're recording this in 2024, interest rates, even if they might dip a little bit, they're not going to dip like they have from 1982 at an all-time high. Okay. So even though bonds have earned 6%, you could really say bonds are going to earn, 3, maybe 3.5%, 4% if you're lucky in the long run. And that's historically what they've earned. Why would you rather earn that over whatever the long-term returns are from the market, which again, due to compliance, you can't guarantee it, but there's never been a 15-year period where the market hasn't gone positive. And there's never been a 25-year period since 1950 where the stock market has done a bare minimum of 7.94%. But let's round it and say 8. Would you rather earn 8% or 3%? Obviously, you'd rather earn 8. But because of your emotional unintelligence to the risk tolerance questionnaire, you can only be provided with conservative investments, which unfortunately, even though you're investing conservatively, your plan just got a whole hell of a lot more aggressive because you have to save that much more and a lot more to successfully retire. Other than that, I have absolutely no opinion on risk tolerance questionnaires. Jokes aside. Number 2, lack of critical thought when it comes to finances. This is a good one. So I'm going to give some people some leeway here and some credit. If you are new to the game of finance, if you are a first-time listener, actually you just got thrown into the lion's den. Okay, so I apologize if you're just tuning in. Okay, that rant was not intended for you, and this the rest of this episode is not intended for you. Okay, I welcome you to the show. We look forward to having you come back for many weeks, many years. So if you're new to the game and you're just starting to learn a couple things, when it comes to the critical thought thing, that you're just getting started, okay? But one thing that has, and I've seen this over my career, and it's actually getting to the point where it's borderline irritating how people want, and this isn't just in finance, actually, this is just in life. Like the amount of critical thought is lacking substantially today. And it just keeps lacking and lacking because all people want is the surface level answer. It's the Googler effect. So you go onto Google and you Google, is a stock good? Is a bond bad? Is a mortgage good? What's a good interest rate? Blah, 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 blah. Those are all surface level questions. I'm not saying they're not important, but you got to dig deeper. You have to have critical thought. You have to be nimble in the mind. We've talked about that a lot in the past on past episodes. And unfortunately, very few people are teaching nimblism in the mind when it comes to money. Okay, I'm doing my best. There are a few out there, but it's few and far between, unfortunately. And one of the examples of critical thought is, and I actually spoke about this a little bit on the episode earlier this year when I went to Berkshire Hathaway and got to see Warren Buffett speak for the first time, my first time. So there was an announcement that happened there where, and this is not investment advice, okay? Let's just be crystal clear for the compliance people out there shaking in their boots. It was announced right before he stepped on stage that he sold off some of his Apple stock. And it was interesting because in the news, the media, all they did was focus on that surface level thing. And the media knows what they're doing because they know you're not going to think deep about this stuff anyway. And so they're trying to get headlines. And so all they did was focus on, oh, he sold a chunk of Apple. And then they zoomed in on Tim Cook, the CEO, who, what's he going to do? He's like, yeah, he did. I mean, I can't control it. And they started just talking about Apple. And I'm going, guys, there's a lot more to it here. He didn't just carve off a chunk of Apple. Now, I don't know Warren Buffett. Okay. I've never talked to him, so I don't have firsthand experience, but I've been around this game long enough where you can kind of put two and two together where these investors' minds are. And so, one of the reasons why he sold off the amount that he did was because if he held on to the same amount of stock between, May and the end of the year, because Apple is buying back more of the company, he would own an amount of the company that would require more regulative duties, so to speak. Okay. And he didn't want to be a director of the company. And there's certain things where if you own more than, let's just take banks. If you own more than 10%, if you have more than 10% of the stock in a bank, you have to do a lot more reporting, and it's a pain in the butt. Okay. So one of the reasons why he decided to sell some of that off is he calculated by the end of 2024, at the rate that Apple is buying back the company, he would actually own proportionally the same amount of the company as he did at that time. Also, he had another investment, Paramount, that had a loss, and he sold that amount, which was almost to the penny the amount of the gain that he had with Apple, which completely offset the capital gain that he would have incurred. He also said that, hey, taxes are going up, they're not going down. So there was an arbitrage tax play in that as well. And let's go even further. Warren Buffett is old, fun little fact. And his, not really right-hand man, but his head of insurance, Ajit Jain, is also getting up there in age. And he has said that, hey, Ajit Jain, the head of our insurance, which is a huge revenue stream for Berkshire Hathaway, we don't really have a backup for Ajit. And that's kind of an issue. In fact, we're very, very nervous of that. Well, being boots on the ground in Berkshire, there were a lot of things I started to discover. And it ended up in the next quarter, it turned out that Warren Buffett started to buy a company called Chubb. It's an insurance company. And there was talks, and I was actually thinking that he could even go and take a run at a company called Markel with the gain of Apple. And the reason why he would do that is not only could he buy, Markel, which is considered a mini Berkshire. Markel is run by a brilliant investor named Thomas Gaynor, who is a brilliant investment mind when it comes to insurance. And he could very well be the second heir when Ajit Jain passes away. And he's young enough where he's got a huge runway. I went to their shareholder meeting. It was fascinating to watch him talk. He's got the charisma. He's got it all. And the reason why I went through all of that, it wasn't a braggy thing. And I could be dead wrong on a lot of that stuff. Okay. But you have to critically think about every single step. Finance is a game of chess. So you've got to think 1, 2, 3, 4, 5, 6, sometimes 7 or more steps ahead. And unfortunately, people just want to look at number 1 and that's going to answer all your problems. It ain't. So think critically when it comes to finance. Now, the third one, before we get into the break and I go chew on some blood pressure medication, how advisors or certified financial planners claim to be doing what is in the client's best interest, but in reality, most don't have a clue how to actually plan. I wanted to read that verbatim. So going back to number 1 on the risk tolerance for a second, time and time again, when I have people come into my practice and we have conversations and it starts out that they have an advisor planner, because most of our clients actually they come from other advising businesses. Most people don't come in just like bone dry. And one of the first things that they ask is like, well, why don't you lead with a risk tolerance questionnaire? I'm not saying it's not completely useless, because there is some importance, but it's toward the tail end of the planning process. It should not be the absolute front. And I tell you that because you've got these advisors and planners, and anytime a client comes in, they go, yeah, that's kind of how it started out. I go, okay, they don't actually know how to plan. And we'll get into some of that in a second here. Actually, you know what? No, we're going to talk about it right now. I mean, there was a client that we took over, and he had sold his practice or his business, done very, very well. And he had, 4 or 5 different accounts at a big wirehouse company. And it was interesting because, when you're close to retirement, you need to be planning for a number of things. Yes, income, taxes, estate planning, locating your assets accordingly so that you can pull it out. And if there's a downturn in the market, you're not getting kicked in the teeth or any other body part that you choose to envision. And then you get hurt in the long run. And every single one of his accounts had the exact same portfolio breakout. The exact same. And it was interesting because a couple of those accounts were taxable accounts, and he was in mutual funds, which I'm not against mutual funds, but when you are a high net worth investor, when you have a lot of money, you're high net worth period, and you have money in a non-retirement account and you have a mutual fund, you are going to not be able to control the tax burden because those mutual funds are going to flow a lot of the tax consequences from the fund to you. And that was like Finance 401. But like people in our industry, gosh, you better understand this stuff. And so this guy was being hammered with taxes. Like over the last 5 years, I think he paid $150,000 in tax that he should not have. He was pretty pissed. Not at me, but it was one of those things where I looked at that going, whoa, and this team, holds themselves out to be actual certified financial planners. It is absolutely crazy. Now, one thing I also want to talk about when it comes to advisors and planners, and they fall on this, is they go, well, we're a fee-only advisor. So you guys have seen commercials on this. I think Fisher Investments is notorious, and they're just so gaggle. It's like, well, we only charge a fee. We don't charge commission products because we always put your interest first. That actually doesn't mean anything, okay? There are times where it's imprudent to charge a recurring fee. So let's take an alternative investment, hypothetically, and it's a real estate investment, and you do the diligence and you outsource to that company. Well, when you outsource, yeah, you've got to monitor it. I get that. But why are you getting paid ongoing when you're not the one actually managing that investment? Because it's illiquid. It's going to sit there. It's not going to do anything, okay? That's imprudent. What about some of these annuities out there? If you have a lifetime income annuity, which you're supposed to own for your lifetime, it's kind of within the title, and you charge a recurring fee for something that's going to sit there over the years. Well, I mean, just hypothetically here, let's say that you get paid 6% commission up front or whatever the case may be, versus you just charge 1% a year because that's in the client's best interest. Well, in 30 years, what's going to happen? You either got paid 6% up front and you're done, or you got paid 30%, right? 1% every year over that period of time. Now, obviously, you're taking money out, so you're not going to get paid as much, but like you get the point. It doesn't matter if you're fee only. In fact, I would say the most prudent way to plan in this business is to be able to charge a commission and charge a fee. If you're managing investments on an ongoing basis and there's liquidity involved, you should have the ability to charge a fee because you have to be very sensitive to that movement. But if you're outsourcing certain investments that don't have any movement, you should be able to charge a commission for that because that actually is in the client's best interest. I know my compliance are probably just pooping their pants right now, but it's the honest to God truth. And someone needs to have the guts to actually talk about this stuff. Now, one other red flag on the advisor or planner side of things that actually don't know what they're talking about. When you hear an advisor or a planner say, we don't work with annuities or we don't touch alternative investments, you want to know why? They don't actually know how they work, or they can't tell you what they actually do. And then you just caught an actor. They're not an advisor. They're not a planner. They're an actor. Your planner, if you decide to hire one, should be able to state the pros and the cons about just about every vehicle out there. A couple exceptions to that. If something just comes on the scene. So for example, I remember in 2017 for the Tax Cuts and Jobs Act, opportunity zones just came on the market. And that's beside the scope of this episode. And I remember one of my CPA buddies called me and he goes, hey, have you ran into this opportunity zone thing? And I hadn't. He goes, what's the deal with that? I go, look, man, it's been out for like 2 weeks. Let me do some more digging and it's going to take me a while. But a lot of these investment strategies and vehicles have been out for years. And I tell you that because other than that exception, if your advisor or planner can't explain the pros and cons of all that and how they all interconnectedly work, you need to find another advisor or planner, like immediately. And if not, it's your retirement, okay? You do what you want to do. I'm just trying to help you out here, okay? And I'm not even saying me. I'm just saying you need to find someone that is qualified and decent for that. So with that being said, we're going to take a quick break. When we come back from the commercial break, we're going to close out these two. And then I'm going to go take a nap because I am wired right now and I'm going to come off of that adrenaline. So stick around.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotu, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. We are going to get right back into the financial pet peeves that rev my engine in the absolute worst way. It's like grinding your teeth on a chalkboard, not your nails, your teeth. How much does that hurt? It hurts a lot. Actually, before we get into this, one little side note. So our 19-month-old has a new pastime. On our back porch, we have those, metal graded gutters. And what she'll do is she'll go, oh, my teeth are hurting now. She'll go and she'll stare me deep into my eyes and take her nails and scratch up and down that gutter and then giggle as my wife and I are grinding our teeth to our gums. So that's really fun in the Ponyo 2 powerhouse. But back to the last two pet peeves of mine, okay? You're welcome for that visual. The obsession with getting rich quick, especially with millennials and Gen Z. Now, when I first was writing this, and after 10 minutes of being pissed off, and then I cooled off, I thought to myself, okay, it sounds great. Like, I get why getting rich quick sounds great. Like, that's been a gimmick for years, and that's not just millennials or Gen Z. Like, that's been for millennia, and I'll tell you though, the odds of you getting rich quick it's next to none. And the reason why I find it odd with millennials and especially Gen Z, it's actually not going to be that hard for you to become wealthy in the long run. Okay. Now you got to stick to the fundamentals. And you got to stay away from the big items that are going to get you in trouble. And we know what a lot of those are, okay? But some of them are you may be unaware of. High interest debt, generally speaking, not that great. Obscure investments. If you don't know why you're investing in something, or you're investing it because like your neighbor told you, you probably shouldn't invest in that. One thing that I've caught a lot of people with that are younger, and it's absolutely, it is beyond deadly to your finances, is investing on margin, where you actually take you basically take debt out to go and invest more money, and then more debt and more money. And then you capitalize on the spread, as we talk about it in the book. But if your portfolio is out of whack and you get a margin call, meaning you have to fork more money in, and you don't have the money, you are screwed. Like, that is incredibly dangerous. And what's really scary is you have been able to get away with investing on margin inappropriately basically since 2011 at the bottom of the great financial crisis, because the market's just been up and to the right like the whole time. Okay. Yeah. 2022 absolutely sucked. And then 2018 was like a flat year, but like all in all, over that long period of time, you've been doing pretty dang good. And so, I tell you all those things of like what not to do. And then as far as like getting wealthy, and you're gonna be like, oh my gosh, this is such an obvious answer. Surround yourself with quality people. I mean, it's incredible to me how many people say, yeah, that I get that. And then they look at themselves and they go, yeah, I do hang out with quality people. But you actually don't even, like, no one really thinks about like the checklist of what they want in a person. A lot of people actually do that when it comes to their spouse or potential spouse, but they don't think about that with like my active friends that I have now. And it's pretty crazy, because if you looked under the hood, not all of you, and I'll tell you, I hope the majority of the people in your life, after you do all this, you're like, you know what? No, I did all this, Chris. And I worked really hard on it. The majority of the people in my life, they're pretty good. They hit my criteria of a great person. That's really profound. Cool. Awesome. I would wager to say that a lot of you out there, when you do that, you're going to be unpleasantly surprised in the short run. But then when you actually go through the practice of surrounding yourself with actual quality people, in the long run, you're going to thank me. Okay. I know it's not a popular thing to say, but you got to hear it from someone. Now, As far as how to get rich as a millennial and Gen Zer, there are very simple steps that you need to succeed. Max out your 401k if you're able to. And if you're not, great. Keep it simple. Put your money into your 401k. And by the time you get to retirement, you will have at least a couple $1 million. You're going to want to also be able to max out your HSA if you have access to it. If you don't have a 401k, then you would want to contribute to an IRA or Roth IRA. And I'm not going to get into tax strategy and all that. That's for another episode. And we've actually talked about that in the past, but I may bring it up again on future episodes. Once you've eliminated all of the easy retirement accounts that you can use at your fingertips and you've actually maxed that out, then and only then do you go and invest in a non-retirement investment account. Because at that point, there isn't the tax benefit of getting a deduction or tax-free or whatever the case may be, and you've exhausted everything else. The only exception to that, though, if you got kids or you're married and you're, husband or wife, you don't want them to have a crappy life if you die early. Obviously, you're going to have to look into term and permanent life insurance, which we've actually talked about on a couple recent episodes. So if you want to go back a week or two to listen into that, you should. But that is the simple formula to becoming successful financially as a millennial or Gen Z. And don't do anything else. It is that simple. Now, the last pet peeve before my heart literally explodes is the financial influencers that prey on the emotional unintelligence of their fans to cultishly lure them into their tribe. So behind the scenes, my brother and I have talked a lot about this, on how it's astounding to me. Part of it's astounding to me. The other part isn't. It's astounding to me how many influencers out there we can see are just faker than fake. And they're talking out of both sides of whatever body part you desire. So there's a couple I'm going to throw under the bus, and I've done that before, and I'm going to do it again. Dave Ramsey's like the easiest example. Like, that is an easy, let's just get on first base. Okay. We're not asking for a home run. It's just, let's put some points on the board here. Dave Ramsey's all about all debt is extremely bad. That couldn't be the farthest thing from the truth. Okay. Now, we've talked about in the past, if you're struggling with debt, how to get out of debt. There are exceptions to that, but chances are most of you that are listening in, you're leveling up a little bit from Dave Ramsey. And so because of that, you need to know that debt can actually be used as a huge advantage to you in the long run, especially if you're going to start a business. I mean, we've talked about a ton of entrepreneurial endeavors where someone goes and says, hey, I took out a 2, a 5, a 10% loan on myself, and my business earned significantly more than that. But you've got to understand the risk and reward of the debt you're taking out relative to what you are going to earn, either guaranteed or potentially earn in the long run. Okay. And here's another thing, like Dave uses debt all the time, which is hilarious because I've actually heard in his company, if you don't subscribe to his principles, you have to disclose all of your finances to him, or not him, but his cult. And if you don't subscribe to all that, you're fired, which is wild because he should be fired. It's absolutely insane to me. And then you've got Robert Kiyosaki, Rich Dad, Poor Dad. I'm not saying it's not a good book. It is a good book, but he is all about debt. And then he gets pretty obscure with gold and all this stuff. But he's the opposite. It's oh my gosh, debt is the greatest thing since sliced bread. You should debt yourself out to the max and then you're not paying taxes, blah, 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 blah. No, no, that is not critical thinking. Let's put on our critical thinking hats for a second here. I'm not saying you need to become Warren Buffett or Charlie Munger and the greatest financial minds of all time, whoever that is. But we're talking second grade common sense here in critical thinking. The ones that I do not get though, and actually it's scary to me, are these TikTokers out there, and they're obsessed with real estate, or they're obsessed with, and I know compliance doesn't like this, but I have to say it, they're obsessed with cryptocurrency or the hot stocks, like whatever it is. Let me tell you something. I will look 10 years down the road and these TikTok moguls, I can almost guarantee you all it's going to take is one correction in any economy and they are going to disappear because they have nothing to show for it. They have absolutely nothing to show for it. And there's also a huge difference there's a huge difference between how many followers one has and then how financially well off these people are as influencers. And, for those of you that like are well off, I would take a step back and look at these influencers and look at what like they're saying versus what they're actually doing. And what I mean by that is ask yourself, are they selling you something or are they actually educating you? Are they actually providing advice in value? Now, at the end of the day, we are all selling something, okay? I mean, shoot, I'm selling something right now. I'd like to say I'm selling my knowledge to you. I'm not really getting paid anything for it. I sell a couple books. Cool. Great. Okay. I am selling my goodwill back to you. And if you want to take it, great. And if not, you got some entertainment from it. But some of these people out there, you can read through the lines and go, oh, well, of course they're telling me to do all these things because all that does is benefit them. That gets a little shady. Okay. And I'll tell you, when it comes to alignment, that's another thing. If you're talking to someone and you ask, hey, well, what are you doing? Now, even if someone is selling you all of this stuff, but they're eating everything they're eating all their own cooking and they're aligning themselves with you and what they're telling you to do. I actually respect that. I may not agree with some strategies out there, but I respect that more so than a lot of these scumbags that will tell you what to do and then they don't actually do it. And they'll never actually do it. Okay. Or they're promising obscene rates of return on investment. Now, and I'll just use kind of one example here. Okay. And I'll just reveal to you guys kind of a little bit about me financially, because I think that's valuable for you to know. For us, I would like to say I could invest more efficiently than certain investment managers out there. But from alignment, I have recommended a lot of clients use the same 401k platform that I do. Because even though I might miss out on a % or two, I can look a client in the eye and go, look, I'm doing the exact same thing. One thing with alternative investments, with a couple exceptions out there, unless my wife and I have invested in the alternatives, I will not recommend them. Period. No questions asked. And again, there are a couple exceptions out there, but I stick to that very, very, very strictly. And so if you chat with a client, it's not, well, if I was in your position, it's, hey, this is why we did this. I believe in this too. This is a significant portion of my net worth or something of that nature. Okay. And the reason why I do that is I run my business that way. For me, I would much rather, from a business standpoint, reinvest a lot more back into my business because I get the tax deduction. You can get a higher return on your invested capital and return on time by growing your business, blah, 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 blah. But I'm not in the traditional world of business. I am in the service business and aligning myself with clients and actually planning for them. And so by doing all of that, taking distributions, investing in those alternatives or whatever investments to be aligned and alongside clients, look them in the eye. Yeah, I might not earn as good of a return as reinvesting in the business and getting the tax deduction, which I would really enjoy. But I get to sleep at night and I sleep like a baby when my daughter sleeps. So, regardless if you run a business, okay, and frankly, as a listener, regardless if you want to, do all of these things or not, you don't even have to like me on this, okay? But I'm just going to kind of conclude all of this, and then I'm going to let you go. Follow what I'm saying here and do what I'm saying. You may not have to like me, but I'm going to do this regardless of what you think of me. And all I want for you is to be as financially successful as humanly possible. So with that, we're going to wrap this episode up. These were my 5 financial pet peeves. I'll see you next week. And as always, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high-yield, small-cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Money market mutual funds, though traditionally lacking federal insurance, are not without risk and are highly regulated under federal law. Before investing, carefully consider a money market or target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.